How I would generate a long-term $6,500 monthly income for retirement. Before we dive in, if advertisements should interrupt this video, please do not click off of the advertisements. Please allow them to play through as a thank you to me for bringing you this honest, valuable information for free. Now let's continue. Most people spend 40 years of their lives building a mountain of savings only to realize they have no idea how to actually climb down the mountain without falling. The traditional retirement model tells you to accumulate a massive pile of cash, cross your fingers, and hope the market doesn't crash the year you decide to stop working. But what if we change the goal entirely? Instead of focusing on a static net worth that you slowly deplete, we are going to talk about building a perpetual income machine. We are looking at exactly how to generate a long-term $6,500 monthly income for retirement that doesn't rely on selling off your assets or praying for a bull market. This is about moving away from the anxiety of price fluctuations and stepping into the role of a strategic asset manager. To truly master this and reach a point where your lifestyle is fully funded by passive cash flow, we first need to understand that capital gains are a bonus, but cash flow is the finish line. The biggest problem facing most investors today is the sequence of returns risk. If the market drops 20% right when you retire, and you are forced to sell shares to pay your mortgage, you are effectively cannibalizing your future. We solve this by focusing on qualified dividends and reliable yield-producing assets that pay you regardless of whether the ticker symbol is green or red. To get to that $6,500 monthly mark, which is $78,000 a year, we have to be incredibly intentional about asset allocation and tax efficiency. This isn't about chasing high-yield traps that offer 12% today and go bankrupt tomorrow. This is about institutional-grade stability. The foundation of a sustainable retirement income strategy usually begins with high-quality dividend growth ETFs. Think of these as the bedrock of your portfolio. When we look at funds like the Schwab US Dividend Equity ETF or similar low-cost index funds, we aren't just buying stocks. We are buying into a filtered process that selects companies with sustainable cash flows and a history of increasing their payouts. If you have a portfolio with a blended yield of around 3.5% to 4%, you are looking at needing a principal balance that feels high, but the growth of those dividends over time is the secret weapon. If your dividends grow at 7 to 10% annually while you are still in the accumulation phase, the amount of capital you actually need to deploy decreases significantly because time is doing the heavy lifting for you. To move from the theory into the actual mechanics of the $6,500 monthly goal, we have to look at diversification across different asset classes that behave differently in various economic cycles. While dividend growth stocks provide the backbone, adding a layer of real estate investment trusts, or REITs, provides a different kind of shielding. REITs are legally required to distribute 90% of their taxable income to shareholders. This creates a massive pipe of liquidity flowing directly into your brokerage account. By mixing the steady growth of blue-chip dividends with the higher immediate yield of physical property through these liquid instruments, you create a balanced ecosystem. This ensures that even if the tech sector or the consumer staples sector hits a lull, your real estate holdings are likely collecting rent and passing that profit to you. As we progress through this strategic buildup, we have to address the elephant in the room: taxes. It is not about what you make, it is about what you keep. This is why understanding the difference between ordinary income and qualified dividends is paramount for anyone looking for a long-term retirement solution. Ordinary income from a standard job or a traditional IRA is often taxed at your highest marginal rate. However, qualified dividends are taxed at the much lower long-term capital gains rate, which for many people can even be 0% depending on their total income bracket. By structuring your portfolio to prioritize these tax-advantaged payouts, you effectively give yourself a massive raise without having to earn an extra cent. You are optimizing the architecture of your wealth so that the government takes the smallest bite possible. To succeed at this level of income generation, you have to adopt the mindset of a business owner. When you buy shares of a diversified dividend fund, you aren't just betting on a stock price. You are becoming a fractional owner of hundreds of the most profitable businesses in the world. These companies have thousands of employees working every day to send you a check. When you view your portfolio as a private conglomerate that generates $78,000 a year in profit, the daily noise of the news cycle stops mattering. You aren't checking the price of your house every single morning to see if you can afford breakfast. So why do that with your retirement portfolio? Your focus shifts entirely to the reliability of the payout. Now, let's talk about the accumulation phase and how we actually bridge the gap to that $6,500 monthly target. Many people make the mistake of waiting until they have $1 million to start thinking about income. That is a tactical error. You should be buying income-producing units every single month. Every time you buy a share of a high-quality ETF, you are essentially buying a tiny permanent pay raise for your future self. If a share pays $2 a year in dividends, and you buy 1,000 shares, you just secured $2,000 of annual income for life, adjusted for growth. By focusing on the share count rather than the account balance, you stay motivated during market downturns. In fact, when the market drops, you should be smiling because your dollars are now buying more income per share. You are getting a discount on your future freedom. As your portfolio matures, you might look into more advanced strategies to bolster that monthly cash flow without adding excessive risk. This could include covered call ETFs or closed-end funds that use professional management to extract extra yield from the market's volatility. While these shouldn't necessarily be your entire portfolio, they act as a yield booster that can help you reach that $6,500 goal with a slightly smaller capital base. It is like adding a turbocharger to an engine. The engine does the work, but the turbo provides that extra push to get you over the finish line. The key is balance. You want the reliability of growth stocks paired with the immediate gratification of high-yield instruments to create a smooth, upward-trending income curve. The transformation happens when you realize that you no longer need a job because you own assets. This is the ultimate form of financial sovereignty. To maintain this forever, you must have a reinvestment plan for when you don't need the full $6,500. During the years where your expenses are lower, shoving those dividends back into the machine creates a compounding effect that is almost impossible to stop. It's like a snowball rolling down a hill. Eventually, it gains so much momentum that even a warm day can't melt it. This is how generational wealth is built, not by selling the golden goose, but by using a portion of the eggs to buy more geese. If you are just starting out, the path might seem long, but the math is undeniable. Start by covering one small bill. Use your dividends to pay for your streaming service, then your internet bill, then your car insurance. Once you see the machine working on a small scale, the psychological shift is permanent. You realize that $6,500 a month is just a series of small, repeatable steps. It is a matter of discipline, time, and choosing the right vehicles that prioritize cash flow over speculation. You are building a fortress that will protect you and your family for decades, regardless of who is in office or what the global economy is doing. In summary, generating a long-term monthly income of $6,500 for retirement requires a fundamental shift from a growth-only mindset to an income-focused strategy. We discussed the importance of focusing on qualified dividends to maximize tax efficiency, the role of dividend growth ETFs as your portfolio's bedrock, and the necessity of diversifying into REITs and other yield-producing assets to ensure stability. We also touched on the critical concept of viewing your portfolio as a business and focusing on share accumulation rather than just the fluctuating market value of your account. By following this process, you aren't just saving for retirement. You are engineering a permanent financial solution that provides peace of mind and true freedom. The biggest takeaway today is that your income is your most powerful wealth-building tool, and turning your capital into a reliable paycheck is the most important financial move you will ever make. If you found this breakdown helpful and you're ready to start building your own income machine, I have a small favor to ask. Please leave a comment below saying this video was very helpful. It really helps me know what kind of content provides the most value to you. Also, make sure to click the thumbs up button to like the video and subscribe to the channel so you don't miss our future deep dives into wealth-building strategies. Your path to financial independence starts with the very next share you buy. Disclaimer: this video is for educational and informational purposes only and does not constitute financial, investment, or tax advice. Investing involves risk, including the potential loss of principal. Always perform your own due diligence or consult with a qualified financial advisor before making any investment decisions. Past performance is not indicative of future results.